Hi everyone, in today's video we will explore Joby Aviation, an electric aircraft startup promising to revolutionize transportation with air taxis. The concept is bold, the ambition is sky high, and the stock price has soared. The price has doubled in just about a month's time now. Since the momentum is so strong, it's tempting to think about investing in Joby right now. Or if you hold the stock, you may be thinking to increase your investment in the startup based on the current momentum. The question is it a wise decision to invest in this stock now? After reviewing a range of recent developments, financial disclosures, and analyst commentaries, the answer appears to be no. In this video, we'll unpack the reasons why Joby may not be the best pick for value-conscious investors at this point in its journey. So let's begin. Joby Aviation is developing electric vertical takeoff and landing aircraft, or what are known as eVTOLs. These are designed to use as short-range air taxis in congested urban environments. They promise reduced travel time, lower emissions. They are cheaper since it's powered by electricity and quieter operations compared to the helicopters. The vision is futuristic, and Joby is positioning itself as one of the early leaders in this space. It has secured major partnerships with companies such as Toyota, Delta Airlines, Uber, SK Telecom, and even the US Department of Defense. On the surface, the company appears to be making real progress. It has completed piloted transition flights, built out its manufacturing capacity in California and Ohio, and is progressing steadily with the Federal Aviation Administration or FIA's multi-stage certification process. Joby has even secured exclusive air taxi operating rights in Dubai for 6 years. The first commercial flights are expected by early 2026. These developments are significant and show that Joby is not just chasing headlines, it is building towards real operation. Despite these impressive milestones, Joby's financial performance tells a slightly different story. For the first quarter of 2025, Joby generated zero revenue. This follows just $25,000 in revenue the year before, which was mainly from US government flight services. The absence of commercial income is not surprising considering that Joby is still undergoing certification and has yet to launch any real operations. But it also highlights the speculative nature of business at this stage. Joby reported a net loss of $82.4 million in the first quarter of 2025, which is a slight improvement from $94.6 million in the same quarter of the year before. However, this improvement is largely due to accounting adjustments related to warrants and earnout shares. When you strip out these effects, the financial picture worsens. Operating losses rose from $145.9 million to $163.6 million year over year, driven by an increase in research and development spending from $115 million to $134 million US dollars. Adjusted EBITDA, another key metric, was negative $127.1 million compared to negative $110.4 million the previous year. Cash flow is another concern. Operating cash flow went from minus $106 million to minus $111 million in 1 year. Joby's cash position, while still healthy, is steadily eroding. After peaking at $1.3 billion in 2021, the company's cash balance dropped to around $812 million as of Q1 of 2025. This includes recent funding from Toyota, which invested $250 million US dollars in May 2025 as part of a broader $500 million commitment. Toyota's support is notable. It not only provides cash but also access to manufacturing expertise. Toyota has embedded engineers into Joby's operations to help scale production efficiently. Despite this, Joby expects to burn between $500 to $540 million US dollars in 2025. This implies that its current liquidity will last only through 2026 or early 2027. To sustain its operations beyond that, the company will likely need to raise more capital. The most probable route is by issuing additional equity. This means existing shareholders will face further dilution. Since 2021, the company has already increased its share count by nearly 58%. This trend may continue unless Joby finds an alternate revenue stream sooner than expected. Perhaps the most striking concern is Joby's valuation. By mid 2025, the company's market capitalization has already surged past 15.2 billion US dollars. That's more than the market cap of legacy players like American Airlines, which has been operating for decades now and has generated over 54 billion in annual revenue in 2024. Joby in comparison is still pre-revenue. Its own guidance suggests it may reach 1.4 billion in annual revenue by 2029. Based on that estimate, the stock is trading at a forward price to sales ratio of nearly 11. For context, the average PS ratio across the industrial sector is just 1.5x. Looking specifically at US airline firms, the difference is even more pronounced. The industry-wide PS ratio for commercial airlines typically ranges between 0.47 to 0.6x. This means Joby is trading at nearly 20 times the sales multiple of established revenue-generating airlines. In effect, investors are already pricing Joby as though its 2029 revenue projections have been fully realized. And not just that, they are also assigning it a textile premium, despite the company having no certified product and no commercial revenue today. Even compared to aerospace giant, the gap stands out. Boeing, for instance, has a PS ratio of around 2.2. At Joby's 2029 forward multiple is nearly 5 times higher than Boeing. This is despite Boeing's ability to build certified aircraft at commercial scale, to deliver airlines, governments, and defense clients, and to maintain established global manufacturing and service infrastructure, and to generate tens of billions of dollars in annual revenue. The comparison extends to the auto industry as well. Traditional manufacturers like Ford and General Motors trade at a PS ratios near 0.5x. These are companies with decades of operational scale, dealer networks, and proven demand. Electric vehicle startups do command higher valuations, but even these are largely based on future expectations rather than present-day performance. Rivian, for example, trades at around 3x sales. Lucid Motors often trades at 6x, and Tesla, the most successful EV brand to date, commands a PS ratio of around 10 to 12x. This means Joby's current forward PS of 11x is nearly as aggressive as Tesla's, a company with over 100 billion in annual revenue, actual profitability, a massive global brand, and an unmatched dominance in EV technology. To justify this kind of valuation, Joby would not only need to commercialize successfully but also scale at a pace rarely seen in the aviation industry. Some analysts project that the urban air mobility market could grow to 30 billion US dollars by 2030. This figure includes potential revenues from air taxi services, aircraft sales, fleet management, infrastructure development, and partnerships with public and private transport networks. But even if the industry reaches that size, Joby would need to secure a significant portion of it, perhaps 10 to 15% or more, just to grow into its current market cap. That's a bold assumption, especially for a company that's still waiting on FAA certification and has yet to generate its first dollar in commercial revenue. Another risk comes from competitive landscape. Joby is not the only player in the eVTOL space. Archer Aviation, Lilium, Vertical Aerospace, and others are all racing towards FAA certification. Archer in particular has made headlines with its Midnight aircraft. It has achieved speeds up to 125 miles per hour and altitudes of 1,500 feet. It also expects to begin commercial operations in the Middle East around the same time as Joby. Although Joby currently holds a slight lead in flight testing and certification progress, these advantages are slim. Any delays in certification or manufacturing could allow rivals to catch up or even overtake. Joby's manufacturing is still in its infancy. Despite its progress in testing, Joby's production capabilities remain limited. As of mid-2025, it is producing one aircraft's worth of components per month at its California site. The Ohio plant is still being equipped with tools and is not yet operational. The company aims to produce 50 aircraft in 2026, ramping up to 500 aircraft by 2028. Half of these are expected to be sold, while other half will be operated directly as air taxis by Joby. If successful, Joby could generate 1.25 billion US dollars in aircraft sales and 880 million in air taxi revenue annually by 2028. However, these are best case scenarios. Reaching that level will require flawless execution and more capital investment. The 1.4 billion US dollars revenue by 2028 estimated by some analysts looks more reasonable figure than this. The timelines for Joby remain fluid. While Joby originally projected its first passenger flights in Dubai by late 2025, the company has revised that to early 2026. FAA certification for its aircraft in the US is expected around mid-2026. The certification process is pending completion of the TIA or the Type Inspection Authorization process. Certification delays could push revenue timelines further out, which in turn would strain cash reserves. Delays could also impact confidence among partners and regulators, potentially slowing down expansion in international markets. Now let's move to Joby's non-binding deals and soft demand signals. Several of Joby's most publicized agreements, including the 1 billion US dollars memorandum of understanding with Abdul Latif Jameel in Saudi Arabia, are non-binding. These types of deals create headlines but do not guarantee actual revenue. Similarly, its Dubai launch, while promising, depends on complex infrastructure like vertiports. These projects are under construction, but costs remain high and timelines uncertain. In Europe, Joby has secured access to Heathrow and Manchester airports through a partnership with Virgin Atlantic. However, the UK Civil Aviation Authority is still aligning its rules with the FAA, which could delay launch timelines further. The eVTOL market has shown a pattern of hype-driven spikes. Joby's share price has doubled more than once within short periods, only to retreat again when the momentum fades. Analyst consensus suggests that the current excitement may not be sustainable. Previous spikes occurred in late 2021 and again in Q4 of 2024. Each time, share prices rose sharply based on press releases and pilot test announcements, only to drop back when revenue or certification timelines failed to follow quickly. This trend may repeat, especially as summer trading volumes slow and investor sentiment cools. No doubt, Joby Aviation represents an exciting vision of the future. Its electric aircraft may one day transform short-distance travel, reduce emissions, and create new forms of urban mobility. But for investors today, the fundamentals raise red flags. The company has no revenue, high cash burn, and a valuation that seems disconnected from current performance. Manufacturing and certification timelines remain fluid. Rivals are closing in and dilution risks are real. Joby may well become a dominant player in the eVTOL industry, but this journey will take time, money, and flawless execution. Until the company reaches a more stable phase of operations, investors may be better served watching from the sidelines. If you found this video insightful, don't forget to like and subscribe. Let us know in the comments, do you believe in the future of air taxis? Is Joby Aviation a long-term disruptor or just another overhyped tech stock? Thank you for watching, and as always, invest with caution and clarity.